Hi, everybody. Welcome. It's Thursday, so that means we are doing another live session today. And today's topic, we're going to delve a little bit further into investing. Last week, we had covered some basics of it and why investing is important. Investing is a way to multiply your money, make it grow so that you have savings and security for your family and perhaps the future generations of your family. My name is Catherine Agupjan, and I run Sisters for Five, where we help you manage your money better so you can live a life of impact today and tomorrow. Thanks for tuning in. I'd love it if you resonate with the content here in this video to give it a thumbs up, whether you're watching it live now or tuning in later. And if you have any questions or comments, please feel free to leave them below so I can answer and get to them. Okay, so today we're diving into investing, and I'm a visual learner, so I will share with you a guide, a visual guide for us to follow through, so that you also have some visuals of how investing works, where to start your investing journey, and really start thinking differently about your money and how you can grow it a little bit better and growing it more, so you can have a life of wealth and security down the line. Okay. Right. Let me. Okay, so what are the important things to know in your investing journey? I mean, investing itself, there's a lot of information that you'll have to understand and process with regards to investing. There's also a lot of companies offering investing products. There's a lot of people offering investing books, workshops, and everything else in between. And what you need to know as an investor is to figure out how to sort through the information and really find the ones that fit your needs, your requirements as you grow older, as your family changes. And there's not going to be a one size fits approach when you invest. And it's important to also keep learning along the way because, as you will realize, investing laws changes, your needs changes, as well as the products changes. So you need to be aware of what those are so you can fully take advantage of what investing can do for you. Today we'll first begin with our options for taxation. So one of the things that people sometimes worry about is that, hey, am I going to get taxed when it comes to investing? And the answer is yes, absolutely, because we all have a right to pay taxes to help some of the social aspects of making sure that we have infrastructure built, we have some social elements to help our society work through. And I don't think it's I don't think we should shy away from paying taxes, but I think it's important that we realize that it is something that we have to do, but there are legal ways and ways that we can minimize those taxes, and we have to know what those are. If you have a great accountant, they will offer you all of these legal ways to do so, and it can be a boon for your savings today and tomorrow. So let's work through. So there's three types of investing buckets, and I call these buckets because basically it is just a a shell or something that you're going to put a few things in. So your first bucket is your taxable. What this means is that you are going to put in money that has already been taxed, and you'll most likely take out money that will also be taxed. So that's taxed twice. And those are for there are accounts called non-qualified accounts, and some of those are just standard accounts that you'll open with a broker. The second option is your tax deferred. And what that means is that you pay taxes later on. So your benefit is that your money is invested pre-tax. So you don't pay taxes today. Instead, you pay taxes when you withdraw the money later on. And this is in your traditional IRA or your 401k, 401k. The last option is called tax advantage. And what this means is that you pay taxes today, you let the money grow, and when you take it out years from now, you don't pay taxes. And many of these accounts have age limits, there's income requirements, because the government has knows that like some of these accounts are very lucrative, especially for people to put in money and let it grow. Some of these buckets are also only available if you work for an employer, for someone that offers a sponsored retirement account. And there's also other buckets if you work for yourself. So this, I'm not going to cover that today, but keep that in mind that there's also similar buckets if you work for yourself and want to retain some of your investments and the growth of that investments a little bit more later on. So we'll break some of these things down. So keep in mind, again, the bucket is the status of your money going in. Has it already been taxed or not? And then when you take it out, will it be taxed today? Will it be taxed later? And there's going to be factors for this. Maybe the money you have there, the amount of time it's sitting there, as well as your age. So keep those in mind, because sometimes we think about like, oh, I'm investing, and you can invest, but you actually can't access some of this money until very much later on, until we're like 70 or 59 and a half. And some of these will have penalties if you withdraw it early. So it's important to keep that in mind so that you know how to allocate your money properly, so you can either withdraw it early without penalties or let it grow over time and then have more when you're older. And the goal of this is to really just do tax diversification. And it's possible for you to have money in all of these three buckets. And in those buckets are those different accounts. It's possible to have all of them. And the goal is that you're just going to hedge your bets against future tax rates. Now, if you are familiar with tax rates, currently we're at the lowest we've been for taxable income, and the United States is on a marginal tax rate, right? So a certain, as your income grows, a certain percentage of your income will be taxed at a certain percent. So it's important to understand taxes as you work towards investment, because what you might find is that when you withdraw money later on, you're going to be hit with a big tax bill, and you're going to be surprised at the fact that, hey, I thought I had more money, but really not. So important to keep that in mind. It's also important to keep abreast of current rules regarding taxation now, because it will change over time, and your needs again are going to change over time. So you have to make sure that those match. You change strategies as I guess the tax laws change, or as your needs and wants change over time. So now that you know what those buckets are of taxation, what do you put in those buckets? So you had in those buckets, you had your taxable, tax deferred, tax advantage, and in those are little account types. And these are just investment vehicles. And what we'll do is put certain things in them. So you might put your stocks, you might put a bond, you might put a mutual fund or an ETF. And I visualize this as eggs because when we refer to them, it's usually like a basket of eggs. So these are things that you are going to kind of hold on to, take care of, so that it grows into your nest egg. And it's important to kind of keep this in mind as you go through, because you might have a stock that grows over time that's in a taxable account that you'll have to pay taxes on when you sell it. You might have a stock that's in a tax advantage that once you go sell it, there's no tax implication because you've already paid taxes on it today. So again, keep those in mind. So what's the difference with all of these? You have your stock, which is an investment in a company. It means a partial ownership of a company, and you have rights to that investment, and you make money through capital appreciation. So if you buy a stock for $100 and it grows into 120, 150, or $200, that difference is your appreciation, and that's how you make your money, your gain. The key thing with some of these things is that you don't make the money until you sell the stock. So you can keep it for a while, you can let it continue to grow over time, but that money doesn't get locked, that your gains don't get locked until you sell it. Same thing if you lose, if the stock depreciates in value, goes down, whether you buy it 100 and it goes down 80 or $50, you don't lock those losses in until you sell it. Over time, some companies provide dividends, which is just a distribution of profits. And this may be another way for you, again, to keep growing your money, right? So held a stock for a few years and it's giving you dividends. So it's actually paying you, it's giving you profit, it's giving you some of the percentage of the profits, and you can buy more stock. So that increases your ownership and number of shares that you own. And I want to show you an example of an actual stock. So this is Apple. This is a holding that this is my personal holding, and this is a holding that I've had for a few years. And I want to share with you the story of how I came to own Apple. And this is something that I think is also important for us to like reshift the way we're thinking about how we're buying stock and assets and liabilities. So it was 2014, and I was kind of on the market for a new phone, but I didn't really need it. It was one of those the year when I would be eligible for an upgrade. And if you recall, normally like a few years, we would upgrade our phone every 2 years because that's when they would release like the latest and greatest changes to the iPhone. So I didn't upgrade. I waited another year or two to upgrade my phone, and instead I saved money to buy Apple stock. At that point in time, Apple stock was fairly priced, and with some of their financials, if you're going to invest in stock, you'll need to do your research, read up on the news, figure out if this company is healthy, the financials are healthy, if there's a belief in the leadership of the company that they'll take it to a new level, and that it's something that you also personally use and have a hand in saying, hey, I think this is something that would grow over time. Now, disclaimer, this is not a recommendation to buy Apple or any other stock. It's just an example of my personal investments. You can see what that looks like and see what that means. So I made the choice to buy that stock instead of upgrading, and continue to do so for a year and a half or so. And that increased the number of shares I own. So it's a quick snapshot of it. So this is the number of shares that I currently own, and this is the current price when I took the snapshot. So you just have to multiply the shares times the current price and your balance. Now, this is where we talked about some of these gains and losses aren't really there until you sell it. So this is your unrealized gains and losses. So this is how much the stock has appreciated over time. And that's significant, right, for a few years. Now, Apple is also one of those companies that provides dividends. Not a lot of tech companies do, but they also provide dividends. So that kind of also goes back to increasing the number of shares I own because it's reinvested in buying back like smaller shares. So this is the amount I would have to pay taxes on if this was in a taxable account. So if I withdraw it, it would go to my taxable income, and there would be a tax trigger for it. If this was in another bucket that I owned and I withdraw it years from now and it continues to grow, there's an option that I would either pay taxes then or not pay taxes at all. So depending on where this sits. So again, this is just one place for you to put your money in and then put it in another bucket so you can get some of those tax advantages. The other option for you to put in your buckets is a bond. And a bond is basically a loan to a company or government, and it pays you, the investor, a fixed rate. So it could be depending on the market, or it could be whatever the issue. It is could be a percentage, and it's over a specific time frame. So what this means is that you get a specific payment to you over time, and the money that you make is really the interest on the loan. So in the same way that banks charge you interest to loan their money, you charge, there's a set price for you to kind of loan your money to a company or government. And this is a great way to keep some of your money without the market fluctuations. And conventional wisdom will tell you that as you kind of grow older and need this money for retirement, going to want to put some of your investments into bonds because it pays a little bit higher than your standard high yield savings account. And it's safer than going into stock market where the fluctuations can kind of make your stomach crazy and also kind of makes might jeopardize some of your savings when you're ready to take it out. Now, these stocks and bonds will also be can also be put into a basket. And this is a basket, either a mutual fund or an ETF. And basically, it's just a combination of either different stocks from different companies or different bonds, companies or governments, or both. And it's a way for you to diversify your account quickly without you having to research a million companies and choosing 3,000 companies to invest in plus bonds and all of that. So mutual funds and ETFs, very, very similar in the way that they have stocks and bonds. And there's a few differences with them. One is bought and sold once per day, which is the mutual fund. The ETF is traded throughout the day, so you can buy it at the price that is listed. And most mutual funds are typically actively managed, or though there are some that are passively, and they have very low expense fees. And your ETFs are passively managed, and they usually are tracked against an index, so which is a weighted set of companies that the index is running against. And mutual funds normally have a minimum investment, so that's something you have to keep in mind. ETFs don't, so you'll pay the price of the ETF when you go to buy it. All right. So where do you hang up your buckets, or basically, how do you get a bucket? To get a bucket, you will need to go to a brokerage firm, and here's a few examples. There's a lot out there where you can hang your bucket or obtain a bucket, and sometimes these firms might already be defined for you if you have a employer sponsored account, and that may already like use the firm to manage that account. These are popular ones: Vanguard, Fidelity, T. Rowe Price, Charles Schwab, available for you to use. And for the IRAs, you can open those directly with the brokers. For the 401k, and that would have to go through your employer. Another option, if these firms don't work for you, is going with a Robo advisor. And you've probably seen a lot of Robo advisors in the news because they're gaining a lot of traction. And basically, they're similar to broker firms, and a lot of them are competing in the same space. Some of them are encroaching on the space that they occupy, but they basically provide the same service. For some of these Robo advisors, what they will do though is they will have you answer a survey to determine what kind of investor you are. And last week we had talked about some of the like 4 things you want to be aware of as an investor. What's your time horizon, your risk tolerance, how much money you have to invest, and how do you want to access some of these investments. So these are some of your popular robo advisors. Now, again, in these robo advisors, you'll have to kind of specify what kind of investor you are, so that they'll recommend, and they have an algorithm that will recommend what investments you should be in to kind of match you with your match to ensure that your investment goals are on track. Is there one better than the other? I don't really think so. I think there depends on what you're looking for. Some of these also have very popular like day trading data and applications. So if that's something you're doing, it might be good to choose one or the other. We'll look at. I will look at some of these to see what it looks like. So what do you want to look for in an online stockbroker? One, know your needs. What type of account type do you want? So those are your buckets. Do you need an IRA or 401k? You need just a regular taxable brokerage. Some of these Companies also have education available to help you invest. Some not so much. So if you want a little bit of hand holding, great customer service, you might want to select one that has those for you. And you also want to see what kind of trades you want to do. Are you going to be passively trading or be actively trading? If you're passive, you might not be interested in a lot of the charting, or you just want some basic information to get you started. You want to make sure that your firm you're selecting is FINRA or SIPC. This is the governing body to ensure that securities are either protected, and there's also they're kind of doing the best interest for you. A lot of these firms are. Just make sure you know that. Keep that in mind, especially since there's also new firms are coming up, and maybe some of them aren't vetted completely yet. What kind of security is in place to protect your data? So this is important because there's money involved in this, right? So you want to make sure that some of these companies are doing either two-factor authentication, getting you transferring your data properly, which allowing you access to it. An important thing: check the fees. Some of these platforms will charge you a fee each time you do a trade. When you buy a stock or sell a stock, they also might great additional like account maintenance fees if you're below a certain limit or for certain time frames. So look into that, look into the fine print. A lot of these companies may also have minimum investments. How much do you need to put in to start investing with them? And of course, commissions. Check their charts, analysis visuals. What is important to you? And this will vary from person to person, right? So if you are an analytics person, if you want to go deep into analysis, you're going to choose a platform that has those capabilities, that has those cool charts, a lot of data that you can export and download and really dive into. Check the platform's usability. And this is important. When you're managing your money, and if you're not familiar or you're nervous about taking a step, you may never invest or buy mutual funds. And this might be because the usability is bad or you just don't know how to do it. And so check that too to make sure. You can also, for all of these, you can open an account and you don't have to fund money to it too. If you want to just play around and see what capabilities they have, you can. So you just don't, just no money that you'll fund. So you'll be okay. And also mobile apps. So people love to access their trades and money and investments on the mobile app. Might be a feature that you want to be looking for to make sure that it's accessible for you. They're constantly updating it and it's something that you want. And lastly, customer service. Many of these companies have customer service that will hand hold you and walk you through what you want to do in terms of investing and how to open accounts. The other alternative too is that if you don't want to go online is to work with a financial advisor. There's a lot of financial advisors out there that can help you figure out your goals and recommend investments for you. It's just keep in mind that while you are working with them, in the back, they're investing these through one of these brokers. Right? So you're not necessarily like hands off and disconnected from these platforms. It's just that like you're not the ones doing the day-to-day management and trading of it. This can be a good option if you don't have time to manage your accounts, if you have complex investment goals and want someone to manage that. This will cost you money. So make sure you talk to your financial advisor to figure out how to get paid, their commissions, and all of that, and make sure you're comfortable working with them. Many will either work for a fee or they may get paid based on how much they manage for you. So ask those questions. And I think even if you have a financial advisor to manage your money, don't forget that it's important to still learn about these things so that you can ask the right questions. So that when something happens and you're not sure, you'll be comfortable asking your financial advisor, what does this investment mean? What does this mean for my taxes, etc. So keep those in mind. And something to keep in mind too as you invest. Now, if you watch the news, which many of us have on the background, you're going to see all of these flashy headlines that are instill fear in you. Worst drop in 2 months, scary time coming. And yes, the market works in cycles and there's going to be dips and ups, but watching this day to day can put fear in you and fear never to invest. So be aware of the content you're consuming when it comes to investing, because if you do so, this will kind of cause inaction on your part. And inaction will lead to no savings, no growth of investments. So be aware of what's happening. If we if we just look, if we just do a quick example of the markets over time. So the markets, when you watch the news, they usually kind of give the numbers for these indexes, which is just tracking like certain companies over time. You'll notice they grow over time. And if you're a long time investor, so from 2000, here's an example, 2000 all the way to 2020, it's grown. There was a dip, but if you notice that dip was only for like a few days and then it goes back up. So if you're a long time investor and you won't need to access this money for a while, then it's good to know that your money over time will grow in these accounts. And know what some of these indexes do cover, because if you some of these indexes will cover like heavy tech. So if you're hearing news of tech companies not doing so well, so of course that the index is going to drop. But it's good to know that these exist, but don't kind of focus your day to day on that. If you're a long term investor, you focus on the long term, and investing in a long term will normally uh, get you a higher investment. Okay, here's our chart. And so now I want to go through a little bit of some of these platforms and some of these brokerages. You can see what they look like. And let's go through. We'll start with um, Fidelity. So I just have a Fidelity fund, index fund that I've pulled up. And Fidelity is one of those more popular companies, brokerage firms that you can park your money in. Many 401k plans go through Fidelity, so you might already have access to some of these. But let's just look to see a sample of an index fund. And basically, this is something that you can buy. So you have to create an account on Fidelity, and then you figure out what type of account do you want. What's the bucket that you want? Do you want an IRA or do you want just a regular taxable? If you want an IRA, you have two options for that: the traditional and the Roth. And then if you're taxable, there'll be an option for just a standard account that you'll choose. And then once you select that account, you'll have to fill it. What do you want? What kind of eggs do you want? And this is one of the eggs you're gonna fill. This is an index one. It's called FZROX. So this is the ticker symbol that you will look for. And one of the things about this particular fund is that it doesn't have expense cost. So you don't have to pay them for them to to buy into this fund. And there's also no minimum invest. So if you're starting with $100 and you want to start investing, you can buy $100 worth of this particular fund. And you'd have to, in order for this to be like a no fees completely to you, you'll have to open a Fidelity account, but it's an option for you. And this is actually a fairly new fund, I believe started in 2018. And you will notice how it's doing over time. So this is the charting that I talked about. So if this is something that like you want to, if this is important to you, want to do a quick more analysis of what you're buying, you want to be looking for some of these things and know how to look for it. Some of these platforms also kind of give you your education options. Like what do these mean? Some of the platforms don't. So when you test your platforms, look to see if those are available for you to use. There is some additional funds that like look similar to these, depending on what they are. And here's also an example of like what does this contains. So this is a fund and it contains stocks, right? So there is a mixed bag or a basket of stocks in it. And this is an example of what it's in it. So you've got some of your popular companies here, probably your most popular companies, Apple, Microsoft, leans heavily a little bit in tech, but you've got your Johnson& Johnson, your Procter& and Gamble, some of your CPG companies, you have Visa in here. So these are very well-known companies, and this particular fund holds that. So you own, you can have access to the growth of these companies. And if you look here, you also see that there's over 2,000 holdings here. So it's a lot of companies that make up this fund. So you have a diversified portfolio in here. The other one I will look at too is Vanguard. So these are the top two platforms out there for someone who is doing it themselves. If you want to do your investment yourself, and let's take okay, so this is a very similar fund to the Fidelity one that I just pulled up, and it's called VTFAX. And if you are in the FIRE movement, if you're watching YouTube videos on what you should be investing in the FIRE movement, this is one of those ticker symbols that you start to memorize, and you'll get to know it very, very well if you're pursuing that. Now, look at the way that this is that they display information here. A little bit different in the way Fidelity does it. So, and there's tabs here that you can see some of your other information, but this is what some of your information that you want to look at. Expense ratio. So this has a 0.04% expense ratio. So you do pay a fee to buy into it. You have a minimum investment of 3,000. So for those that don't have a 3,000 to invest, this may not be for you. And this is some of the growth and other information. And on to the bottom is some of your holdings too. And I want to show you some things. So in the holdings here is the 10 largest holdings. And you notice it's the same, almost the same. Tesla is probably the only change between these two funds. So something to keep in mind that some of these funds are very similar in what they invest in. Sometimes the costs just vary from company to company, and you want to be aware of that and then look for those. This one has a lot more stocks, though. It's over 3,000. The other one had over 2,000. And there's also some, some of the ways that they manage some of these funds will also vary. Let's see. I believe some of its prices over time. And then so we talked about the mutual fund versus the ETF. So this is a 3,000 minimum. If you don't have the 3,000 one, instead buy an ETF. You can get the ETF, and the ETF will be similar investment. You have the same companies investing in mostly, but instead you will buy it at the market price. And the market price right now is 167. So instead of the 3,000 that it requires for the minimum for the mutual fund, you would, if you want to share, this would be 167 for you to invest in. Okay, and let's see if I can pull up other account I will show you is WeBull. I'm going to stop sharing for a second. I can begin. Okay. The next option is for us to look at WeBull, and WeBull it's a new platform that I'm personally just currently testing to see if they have something that I need. And I brought this up because WeBull is doing this interesting promotion where if you sign up, you get a free stock. And if you deposit $100 to that account, you'll get another free stock. So you kind of automatically get 2 free stocks for just putting in $100 towards for your account. And an interesting proposition that they have, and I thought if someone might be interested in that, they could take a look. WeBull works a little bit differently because they they have just a different, nope, because their platform is very mobile based and mobile friendly. So what you'll see is uh, a very heavy analytics platform. And you'll notice some of their charting looks different. And they're actually, again, mobile friendly. So by mobile first. So a lot of this stuff is on their app, and it's easy to trade on the app too. So if you're interested and want to look at that, you can take a look at WeBull. WeBull is fairly new to the game, but they've gotten a lot of traction in the past few months. Again, another option. There's so many options out there. So just keep in mind what those are, so you can see what they look like. Okay. Right. So I would encourage you at this point to really look into of investments. So one, if you already own investments, look into and review what they are and see if they meet your goals. This is especially important if you started a job and they might have just put you in certain investments right off the bat and you haven't looked at it in a while. Two, it's also good to look at your investments to make sure you're actually invested in something that you want to be invested in, and maybe it's switching to funds that have a little bit low cost or funds that are growing a little bit faster over time. And then the third item too is that if you're new to investing and you want to start learning, go to these platforms, take a look at some of their education centers, see where you feel like you like the usability, you're into how the layout of the platform is, and what kind of like investments you want to make. And this is just again the starting point, right? So don't be afraid to do a little bit of a dive into this. Open an account. You don't have to fund it. Open an account. When you do open an account, they'll require certain information because they will have to report your earnings if you sell to the IRS. So it will require some security and some personal information to verify your identity. So it does take some work to open an account, but after that, it'll be easy for you to work with a platform, figure out which buckets and account types you want, and then start investing in other stocks, funds, or a mix of all of those, and we'll get you a little bit going with your money. All right. So I think that's the end of our session for today. I appreciate you tuning in, and let me know in the comments if you have any questions. And if you feel like this content was helpful for you, please click the like button and let me know. And um, if you're a new investor and want to get a little bit more in depth, let me know, and I will send you some resources to help you along the way. I also recommend heading into, if you're already on YouTube, check out some of those videos. A lot of the influencers are sharing, and I see this a little bit with both a disclaimer and with also a little bit of an encouragement because there's a lot of good content out there for you to review. And if you can understand, get to know some of the lingo behind some investments, it can remove some of the fear and worry that you may have about it. And it can get you started a little bit faster. So if you want to check out Sisters for Fi YouTube channel, we have a playlist of investing videos for beginners as well as those in the fire journey. And I will link those somewhere here or below, and then you will see those and take a look and spend some time doing them. All right, so I appreciate your time. So my name is Catherine Akopchan, and I run Stitch for Fi, and I hope that tomorrow you can take action to manage your money better. Thank you for tuning in. Bye.